multifamily, at least in the past. So Paul will talk about that, but more recently, more on mobile home parks as well as self-storage facilities. Welcome, Paul. It's a pleasure to have you with us today. Why don't you give us a brief background about you as well as Wellings Capital?
Yeah, it's great to be here, guys. Thank you so much. Yeah, I had an engineering degree, which was my first mistake. And then I got an MBA, went to Ford Motor Company, was there for about 5 years, then spent 5 years managing my own company and sold it to a publicly traded firm, moved to the Blue Ridge Mountains of Virginia, where I started flipping houses, and then went from flipping houses to expensive waterfront lots at a lake resort here in the Blue Ridge Mountains, and then did a small subdivision. And I was always wondering how people got in commercial real estate. I didn't know how. And my friend and I we invested in oil and gas in North Dakota. And we saw that there was a huge housing shortage. So we built a multifamily complex. Then we built a second one, and we managed those for years. I ended up writing a book on multifamily called The Perfect Investment in 2016, and that's how I got into commercial real estate.
Oh, that's great. I think one of your pieces to fame also, I believe, is that you were on HGTV's House Hunters at some point, right? In your early house flipping careers.
Yeah, that's right. In 2008, I was on House Hunters, and that was a lot of fun.
Yeah, I can imagine. So it's great that you wrote that book, The Perfect Investment, about multifamily. But I believe now you have shifted gears. So why is it that you write that book, but now your focus is more on mobile home parks and self-storage facilities?
Yeah. So guys, the perfect investment is not perfect if you have to overpay to get it. And, we've had a lot of stuff happen the last 7 or 8 years. Since the end of the great financial crisis, we've had a lot of international investors investing in the US. We've also had a lot of institutional investors buying smaller and smaller assets. We've had IRA investors, more and more self-directed IRA investors investing, and some of them aren't as careful with their investments because they feel like it's in an IRA for some reason. We've got a lot of newbies, and I like, a lot of these newbies have actually become gurus, at least they say they are, and they're telling us it's okay to overpay for multifamily. So I call these guys new-rus. These are new people who are now gurus, and they're trying to convince us it's okay to overpay. The price always goes up. And you know what? I don't think that's really good sound advice. So my company found ourselves for years, like 3 years, bidding against people who were overpaying for assets by 10, 20, 40% even. And I just didn't want to play that game anymore. So we decided to check out the other type of multifamily, which is mobile home parks. And then we checked out self-storage. We were so happy with the results that we decided to launch a fund. And now we've done 3 funds with self-storage and mobile home parks. And we've got, we syndicate those funds, and we actually place the money with the very best operators we can find, and then they do the heavy lifting.
That's great. John, right, you can attest to this. You're looking at deals on a daily basis with these, with a lot of multifamily sponsors that bring us deals, and we need to underwrite them from a debt perspective. So maybe you can give a little bit of a flavor of what we see on a daily basis, right?
Just sure, Paul. Anton, Paul, if you haven't looked at a set of financials here lately, Paul, it's getting pretty thin. The challenge, as you articulated, is the appetite and demand for cash flow investing assets, and unfortunately, like the cap rates haven't necessarily favored investors. Even as we're beginning to recover a bit from this pandemic, people are looking up and forward and into the back end of the year of possibilities of improvements in rents and the underlying demand for housing and maybe the capacity to lift rents. But given the uncertainty we just came through and in the rate environment, this excess liquidity seems to continue to pressure the returns. So we're welcome to hear what you have as far as other ideas and other assets, maybe similarities and pros and cons of looking up and kind of broadening horizons a bit.
Yeah. What I love about self-storage and mobile home parks is the fragmented nature of the ownership base. Let me explain. It's been said that 93% of the multifamily assets over 50 units in the US are owned by companies. These are companies who have already wrung out the value. They've done the value adds. They've done the heavy lifting. And so it's really hard to get upside on these with low interest rates and low cap rates. There's just not a lot of room for error. But in self-storage, there's about 53,000 self-storage assets in the US. That's the same as McDonald's, Starbucks, and Subways combined. And about 75% are owned by independent operators. And most of those are mom and pop operators. Most of those are operators who have maybe one deal that they own. And so they don't have the wisdom, they don't have the value, the time, the desire, they don't have the resources to maximize the income from these assets and really create a lot of value. And they don't care because maybe they've owned them for 20 or 30 years and they're just coasting, making a lot of money, and they're all benefiting. If they decide to sell, they're going to benefit, even if they're not well run, from this huge cap rate compression. Like some of their assets have doubled in value in the last 10 years, and they're not even any better than they were 10 years ago. Mobile home parks are even more dramatic, guys. Mobile home parks, there's about 44,000 in the US, we believe, and about 85 to 90% are owned by mom and pop small owners. And they definitely typically don't have the resources, the knowledge, or the desire to maximize income and value from these properties. And so as a result, a professional operator can go in and they can pay a great number to the seller. We'll call that the extrinsic value of the property. But they can see beyond that to the intrinsic value. And that's the value that they can get it to by doing things like there's all kinds of value add things they can do that are pretty easy and sometimes easier than the multifamily world. And as a result, they can raise the value. Sometimes they can raise the value, like we did one last year, a mobile home park in Louisville. It was acquired for about $7 million. That's about $3.5 million equity and about $3.5 million debt. And it was sold by December for $15 million. And so that $3.5 million in equity went to close to $11 million on the way out in just 10 months. So that was a 344% IRR and a 3.4x return on equity. And that's just in 10 months. Now, that's not normal, but I want to tell you guys that process is normal. The process of finding an undervalued mom and pop property, because this property was a very nice mobile home park with 300 and some lots, but the owner hadn't even been there in 5 years. And so there was lots of room to improve it quickly and easily. And it's the same with self-storage. We had a very similar story to that in Beeville, Texas. There were 4 kids. They were all 5 kids, actually. They were all fighting. Their parents had passed away. They didn't want to run the self-storage. They offloaded it for $2.4 million, and we sold it a year and a half later for $4.6 million. And so very powerful. I mean, that was like a, several 100% return on equity because we bought it for cash, raised the value, then put debt on it, So it only had 400,000 in equity left in it. So 400,000 in equity after say 6 months went to, 2.6 million in equity when it was sold. So it was a very nice gain. And this is really powerful for investors these days.
Yeah, that's great to hear. I think what you mentioned earlier is really a very important point, right? Where you have so many people flocking into multifamily. Now, when we look back maybe 10 years, I would say there was only a segment that was also so-called mom and pop owned at that point, right? Because these were properties that were not institutional grade. And the pricing on these properties usually, particularly in the C-class space, as you know, was in the $10,000-$20,000 per unit. So a family or an individual could easily own 100 to 200 unit property because the value was not really that great, but it was way below of what the value would have to be for institutional investor, right? So what is interesting to see is that as the syndicators came on into play, obviously 2012 with the Jobs Act and all that had a massive impact on that. But what we also have seen in the meantime was that you have one syndicator buying from another syndicator, and they all claim that you do a much better job than the previous one. So what you have mentioned, right, that you can make these improvements. At some point, there is just no more meat on the bone to make these improvements.
Right.
So the only way they can make these improvements come up with pro forma numbers that somehow show an improvement. And we certainly have seen it over the last 2 to 3 years that very few of these pro formas really turn out to be as good as what the pro forma was claiming, despite still a very favorable market, right?
Yeah.
So I think you certainly picked a very good time to shift gears. But I still have a question when it comes to mobile home parks, when it comes to competition for assets. We talk to quite a number of mobile home operators on a regular basis, and it appears that they're also kind of struggle to find assets that still make sense to them, because obviously players like you and others, they have the funds available. So there is quite a bit of competition there too. So I'm wondering, how do you are able to still identify the opportunities and actually win deals that make financially sense and still not overpaying?
Yeah, great question. So one of our operators sends a guy out about 50 weeks a year. He travels a lot. He'll fly in to a city and he'll get all the intel of all the self-storage facilities around that area. And he'll go drop in all he can. He'll try to get their cell phone number. He'll try to get the owner's number. And he'll drop in lots of these. Sometimes he'll find some that weren't even on the map for some reason. And he will try to buy these all around these concentric, central locations. So it's sort of the hub and spoke model. Another operator had 4 people working the phones full time. They were calling self-storage and mobile home park owners and operators, and they were trying to see if they wanted to sell. And it worked so well with those 4 people calling 8 hours a day, 5 days a week, that he actually added 6 more. So now you have 10 people working the phones, 10 people who are out there looking to acquire these properties, to buy them for this operator. And then once they buy those, again, when you have that many people working the phones, guys, you've got a large choice. You could say no to a lot of good deals to get the very best deals. And so if he's looking to close on 1 or 2 deals a month, he's able to say no to dozens because he's got these callers.
Very good. So there the issue is kind of similar, right? So you need to underwrite a lot of deals until you find that diamond in the rough that actually makes sense.
Yeah.
Yeah.
That's it.
Yeah. That's good to hear. Obviously, that's the challenging part. Now, you are not getting involved on the operation side on a daily basis, right? So you are picking the right operators and then essentially monitor their activities.
Yeah, that's right. We're spending a lot of time. We consider ourselves a due diligence partner for our investors. We do a lot of heavy lifting to find the right operator. We take our time. We usually spend 4, 6, 8 months trying to get to know an operator. We drop in on their properties. We go to their headquarters. We see how they talk to their employees and their spouse and their investors. And we do a lot of due diligence. And then once we find the right jockey, we trust them to find and train the right horses.
That's great. So you go through a long period just to identifying them and getting comfortable with them.
Right. That's it.
Yeah. Okay. Have you had a situation where you actually had to drop an operator because after you decided that it's the right jockey, that you still had to say, I think we made the wrong choice?
We had so we have an operator who asked us if we wanted to go out and look at a facility with him. Now, he is top flight in every way, but we saw some things we didn't like. And so we told him, we don't think this is the best fit for your fund. And he looked at those same things and he agreed. So he cut that asset. But if he would have bought it, we trust him so much. His track record is so good. I think it would have been fine. Another one, we went out on site and we were doing due diligence on this location. And we found 2 different times, twice, that there were other brand new self-storage facilities being built near the one he was doing the investment in, and neither time he was aware of it. I really think he was telling the truth. I don't think he was aware of it. So after that happened twice, we've generally not invested with that operator anymore. We still have 3 investments with them from years ago, but we're generally not investing with them anymore because of that. Another operator, everything looked great, but he was putting none of his own money in it, 0 skin in the game. And we decided with him not investing any of his own cash, we decided to not invest with him.
Mm-hmm. So what is generally the percentage you would like to see an operator to invest?
Oh, their own money. Well, I can just tell you a couple examples. One of our operators raised $57 million, and he invested $3.5 million of his own money. Another operator raised $150 million, and he put in 11 or 12 million of his money and his team. That first operator is doing a new fund. He's raising about 100 million, and he's putting in about 10 million of his own.
Okay, so somewhere in the 5 to 10% range of the total.
Yeah, I think that's good. Yeah.
That's I would say that's fair, right? And hopefully it's not just the acquisition fee that they turn back into the deal, right? What we see on the multifamily side, as you know,
Right.
quite a bit, where they claim we have skin in the game, but they charge a 2 or 3% acquisition fee and put that money in, and then claim, oh, now we have our skin in the game.
Right.
Yeah.
Yeah. You're right.
So, Paul, quick question. Then, as you're looking at a stable of operators, do they tend to be geographically concentrated, or do they have a good reach? And if they are concentrated, how are you getting new operators into the bench, so to speak, and trying to figure out who's next that you want to work with?
Our goal is to give diversification across operators, geographies, assets, and strategies. And it's sort of the Warren Buffett model. Buffett Berkshire Hathaway owns Dairy Queen, but he doesn't pick the flavors and he doesn't pick where they open stores. And so because he trusts the managers of Dairy Queen so much, he trusts them to make those decisions. It's the same here. We do not pick geographies. We generally stay away from California. And if somebody was heavily focused in California, we would have to ask them, we'd have some really hard questions for them, right? But no, we generally have nothing to do with the geographic selection once we pick an operator. Now, if we knew they were doing a lot of self-storage in an overbuilt area, that would make us question it.
Mhm. Okay. So what is the reason why you would want to stay away from California? Obviously, multifamily and maybe mobile home park, it makes sense, right? Because of all the rental laws and all that. But why would that also apply to self-storage?
That's true. We just honestly, our concern is that the government overreach and the taxes and all the different rules and the increasing rules in California might apply to everybody. And so I'm not saying we would not invest in California. I'm just saying if somebody was heavily focused there, we would really be a little nervous about that.
It wouldn't be your first choice. That makes sense.
Right.
Yeah. So how did that or those deals go where the operator wasn't aware of the two new facilities? That's obviously one of the key concerns with self-storage, because the barrier of entry is not really that high, right? You can build a new facility really quickly. So how did that turn out for you guys there?
So with one of them, we invested and it's been mediocre. Honestly, this was years ago and we would never do it again. We thought that the growth in the area was explosive. I mean, it's really literally explosive growth, but the new facilities really slowed down the returns on investment. On the other one, we chose not to. We were all teed up to invest. We were going to invest a few $1 million. Like, we were doing our investor webinar the next day. We'd already spent thousands in legal fees, but we told them this is not good. And so we decided not to invest in that one at all. I heard it went okay though.
Yeah. Okay. So apart from geographic regions, are your operators more on the self-storage side more focused on infill, urban infill, more on suburban or then rural areas, or is it a combination of all the three?
It's definitely a combination. The smaller towns, honestly, Anton, have done better in some cases. I mean, like Greenville, South Carolina has 800,000 or 900,000 people in that area, plus Spartanburg, and it's been really tough. It's been overbuilt in self-storage. Yet we also invested in Grand Junction, Colorado. We invested in Beeville, Texas, a town I'd never heard of. And those have done really, really well, and they haven't had much competition. So we like small towns. We can't, the large towns can work out pretty well as well.
Yeah, good. How did both on the mobile home park side, I'm pretty sure it performed really well during COVID-19, right? Obviously, everyone has some bad debt issues, but I think we can all agree that from affordability perspective, mobile home parks are definitely the place to be in when times are tough. But can you tell us a little bit how the performance was for both mobile home parks and the self-storage during that time?
Yeah, I hate to be so optimistic about everything, but honestly, self-storage and mobile home parks with professional operators did fantastic. Now, I've heard multifamily did really well too. And so I think we're just very, very fortunate in the United States that we've had, we haven't been hurt. There's countries around the world. My friend's in Ethiopia right now. He's actually in Sudan today. He'll be in Ethiopia Friday. And he said that they've been devastated by COVID. My friend does mission relief work in Kenya, and they've been devastated by COVID. And so we're very fortunate in the US in general that we have just, largely escaped a lot of the worst economic crunches from this. Self-storage and mobile home parks. Green Street, who's an analyst who analyzes a lot of commercial, says that mobile home parks are the darling of commercial real estate right now, and just we've just been very fortunate to be there.
Yeah, that's good to hear. So that message from Green Street is very positive for you as an owner. It might not be that positive to acquire new properties because now you have even more more money flowing into it, right?
Yes.
Yeah,
that's right.
Yeah.
So Paul, quick another question. Then you just was thinking about as you're kind of commenting about how the U.S. has responded during the pandemic. I think most of our listeners, as you as well, would noted the kind of this reverse migration, out of urban cores back into suburban areas, driven in part by the ability to remote work. Is that impacting your operators with regard on the self-storage side? Is there any impact necessarily on the mobile home park side as well? And or what are some of the demographic trends that you see that make these asset classes favorable, not just the granular ownership, but what are the any other underlying trends?
Yeah, so the self-storage does really well demographically when there's 4 unfortunate circumstances. Those 4 are the 4 Ds. They're death, downsizing, dislocation, and divorce. And all 4, unfortunately, of those have happened a little more than average lately. And there's just a lot of turmoil. People are downsizing, or people are moving from Manhattan out, to Charlotte, North Carolina, for example, or Smith Mountain Lake, Virginia, where I am. And so with that downsizing, or with that relocation, I should say, there's actually self-storage has done quite well. People are building homes, people are moving into a different home, and a lot of them need a place to store their stuff. Mobile home parks, again, there have been some eviction moratoriums, but the really, really well-run parks are still doing great. I think that mobile home parks are generally, not located in big downtowns. Obviously, there's exceptions. I think I saw one in Houston and other cities, but overall, they're not in large urban cores. And so when people are moving out of the large urban cores, mobile home parks are sometimes benefiting from that. One problem, guys, is that I can't prove this is true everywhere, but from what I hear from operators, it takes up to 8 months now to get a brand new mobile home when you want to buy one to put on a lot. And so these, these mom and pop operators, they have very little chance of getting a new mobile home, at least anytime soon. These large operators who have lots of buying power, resources, relationships, some of them buy used, from the government even. They know how to do that, and they're getting further and further ahead as a result.
Oh, that's very interesting. So I thought generally operators prefer not to own the mobile homes themselves, right? But if I understand you, what you're saying is they are actively providing the supply of the mobile homes for the people that actually want to own one and put it onto a pad.
So we had 50 vacant lots at one mobile home park. And so for us to advertise, no matter how much our operator advertised, they're only going to fill a few of those spots, if any, during a year. So a great operator will go buy a used or new mobile home. They'll put it on the lot, and then they'll get financing arranged through, let's say, 21st Mortgage, which is a Warren Buffett, Berkshire Hathaway company, or they'll get financing arranged for through somebody else who likes to finance mobile home parks or mobile homes, and then they'll sell the mobile home to an individual. And sometimes they can get 100% financing. So you're right. The mobile home park owner doesn't want to own that home, but they will own it long enough to get a tenant buyer who actually buys it. Is that your experience too?
Yeah, that's exactly where the good operators are separating themselves from the mom and pop ones, right? They just do not know how to deal with the situation, right? So they
Right.
know that they need to fill it. They have, but they don't have access to inventory.
Yeah.
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 That's true.
Yeah. So when it comes to looking into 2021 and 22, do you foresee that you stick to mobile home parks and self-storage for the time being, or will you look back in 2 years and say, that was the greatest thing, I need to write a book, but now it's something else?
Well, we plan to stay involved in self-storage and mobile home parks as long as we can find operators who know how to find these, mom and pop fragmented deals. But we're also looking, forward to the day we can get involved in multifamily again. We're also looking at senior living. We have a friend who does a lot of senior living, and he's making a tremendous profits. And he seems quite safe, but it's ground up development, which makes us pause a little bit. We would consider data centers, but it's just not something we really know much about. So those are some of the things that are on our mind these days.
On the senior living side, are we talking about independent living, assisted living, or continuous care facilities?
Yeah, to my knowledge, there's independent living, and then there's assisted living, and then there's skilled nursing facilities. And
Right.
we want to go at the lowest level, the independent living, if we decide we want to do this.
Okay. All right. Very good. So good to hear. Obviously, from a demographic perspective, there's only a big need for it, right?
Right.
There is also a big need, obviously, for assisted living and ultimately skilled nursing, memory care, and all that. With all the boomer generation at some point reaching that assisted living age, right?
Right.
Yeah.
Yeah, it's absolutely true. There's 10,000 people, guys, turning 65 every day. 6 in 10 of them have less than $10,000 saved for retirement. So those 6 in 10, they're not going to be moving into a senior living facility for the most part, but a lot of them will move into mobile home parks because some of them have equity built up in their home, and they're willing to trade that equity for a mobile home park lifestyle. As a result, mobile home parks are booming, with seniors moving in there. And also there's an affordable housing crisis in general, as we all know.
Yeah. Yeah, that's a very good point, right? So when you look at really dig into the demographics, right, at the almost parcel level, obviously sometimes it's available, sometimes not, but it's really interesting to see when you look at cities and towns, and you circle into that mobile home park, how the age bracket really changes, right? And that definitely supports that you have a lot of retirees that move to mobile home parks because that's one of the affordable ways to do an independent living without still staying in your home.
Yeah, it's really true.
Yeah.
Yep.
Yeah. Very good. So, Paul, thank you very much for sharing your insight. So, how obviously it's important that our listeners can reach you. I assume that you are not looking for more operators. I'm pretty sure that you know everyone out there who you would trust. But you for individuals that also want to invest with you. How would they be able to reach you?
Yeah, we're always evaluating more operators, and we do get some of those referred by friends. In fact, one of our investors named Anton referred us our best operator years ago. And so we're generally connecting with investors these days. And so people can reach out to me at my company, wellingscapital.com. That's WELLINGSCAPITAL, wellingscapital.com. And we have some resources there, including a special report, which is an ebook on getting involved in mobile home park investing, another one on self-storage, and then another course on commercial real estate investing for beginners.
Yeah, that's great. Always very valuable to provide free advice, right, for investors, rather than just asking for the money, right? I think what is also important to mention is both Paul and I, we are in the real estate guys resource network.
Oh yeah.
Right? The real estate guys are well known, right? So they are probably the ultimate podcaster, even though it's called the Real Estate Show. They have started out earlier than anyone else, and they are very picky whom they want to have in the resource network as their trusted advisors for the listeners. So Paul is also one of the few in that group together with me. So I'm proud to have you as a co resource person in that group. And I think that solely also for our listeners, it's important to highlight, right, that when you have others that have looked into your background, that you're comfortable with you. So that's also, when it comes to the due diligence that you have mentioned, is so important when you do your due diligence of operators. It's equally important when someone wants to invest with you or anyone else, that they do a proper due diligence. And I think the fact that also the real estate guys have rated you and are supporting you is speaking very positive in your favor.
Thanks, Anton. Same with you, my friend, and I'm glad to be there with you. I'm thinking about going on the Belize trip instead of the cruise this year. So anyway, maybe I'll see you there.
Yeah, very good. So thanks again, Paul. It was great having you on, and all the success for this year and next year in your investments.
Thank you so much, Anton. Thank you, John, and thank you everybody else. It was really an honor to be with you today.
Thanks, Paul.